The Robert Debbas, managing partner, follows real estate quite closely. What's interesting about this, and I think Jerry touched on, is this notion that 5% is a jarring figure for people who were getting used to for a while. 2-something, then 3-something, then 4-something mortgages. It's all your age and perspective. But for a lot of folks, it's compounded by this idea that home prices themselves are moving up smartly. So if you're not getting it on the mortgage rate, you're getting it on the price front for the house itself. Where do you see this hitting real estate, or will it?
You know, Neil, it's good to see you. And I think that the demographic that's going to suffer the most from this is the first-time home buyer. Because when you look at rates going up, you know, you and I spoke over the summertime, and the 30-year fixed rate was hovering around 2.8%. And here we are 9 months later, you know, we're 125, 130 basis points higher than that. And, you know, couple that with the fact that prices have only appreciated since the summer. And, you know, they even in the last quarter, they still appreciated, even with, you know, volume going down. You know, that high rate increase is really just going to really price out would-be first-time home buyers when you talk about the price appreciation and the fact that now in the last 12 months, your average monthly mortgage payment is 28% higher than it was a year ago. So it's going to make it basically essentially unaffordable for most people to buy an entry-level home.
So what happens then? If at the margin, I mean, sometimes these can be very close. Sometimes 1/10 of a point, 1/2 a point could do it and push you out. I'm just wondering, though, do homeowners then hang on through this, not decide to sell their house, thereby limiting the supply again, thereby keeping prices maybe continuing to move high as mortgage rates are moving higher as well? In other words, I guess what I'm asking is, some people look at housing as a bubble. I don't see any of the things that were featured more than a decade ago in the last housing bubble, but that it burst, or at least loses a lot of air. Where are you?
You know, I think you're spot on. When you look at it, inventory is the lowest it's been since the 1970s. And what's going to force movement in the marketplace? Creation of housing stock, which with labor shortages and supply chain issues is going to take several years. And then what's going to force people to sell? Maybe they're going to capitalize on the appreciation and that they're going to make profit, but then you have to relocate. And where are you relocating to when you likely refinanced in the last 2 years and secured a rate in the 2% range, and now you're going to relocate, the prices are appreciated, and you're paying double the amount of interest that you were? It's going to be a disincentivizer for many to move and sell. And that's going to, you know, I know that the whole point of trying to increase rates is to temper inflation and bring down pricing and a correction and all the things that people say. But quite honestly, I think it'll slow down continued growth. I don't think it will bring down pricing much at all, because at the end of the day, we still have the supply issue, which is not being addressed. And that's the most important issue out of anything going on in the housing market right now.
Pending sales and those who are looking at homes, I mean, whether it's hard data or anecdotal data, it's not what it was. Housing, you know, froth is not what it was. Now, of course, you would know that looking at places like Florida, you know, a lot of other high-value locales, even Texas, but that it's starting. Assuming we're off some of those highs, are you saying that the growth just slows, but the growth remains?
You know, I think we created a new normal in the housing market. So I don't think price growth continues. I think it stabilizes, maybe with a minor reduction. But I don't think we're sitting here in any sort of bubble that we were in maybe 2008, 2009 whatsoever. I mean, when you look at the percentage of down payments, how high down payments are, when you look at the percentage of cash deals, you know, percentage of cash deals is roughly 25% of all transactions are cash.
Is that right? So much, I didn't know it was that high.
Yeah.
Wow. Right.
Yeah, it's a staggering number. And what does that create? There's so much equity and liquidity in our market that it's not based on, you know, the excessive credit, you know, that was given out a dozen or 14 years ago. So you know, to be quite frank, you know, I don't really see, you know, things having much of it. I see the appreciation continuing, but I don't see this resulting in a significant reduction in pricing.
Yeah, I don't see people sight unseen bidding on properties. I don't see them getting approved for mortgages and all, you know, without any proof of income or all of that. I mean, if you just had a heartbeat, that was good enough in the past. I don't see any of that. So the sort of the bubble type things that you would see, I don't see.
Right. I mean, Neil, I can tell you, you know, as a real estate attorney representing our firm represents 40 institutional lenders and hundreds of buyers and sellers on an annual basis. The banks are lending at a very healthy underwriting. The lending is conservative, the down payments are high. There's none of the shenanigans that took place during the financial crisis that created the recession whatsoever. So that gives you a high level of comfort that this housing market is not a fabricated market, in my opinion.
Interesting. Well, your opinion's pretty good. Pierre, thank you very much. Good catching up with you. Pierre Debbas, the Robert Debbas managing partner, taking a look at real estate. There are some similarities to bubbles in the past, but nothing approaching the big bubbles we've seen in the past. So perspective does come in order.